Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
David Sherman, Chief Investment Officer, CrossingBridge Advisors, joins us here in studio. Why in studio? I have no idea. Maybe he's returning some gifts here. David, boy, when you look at the equity markets in 2025, 15% gains in the S&P 500, 20% gains in NASDAQ, fixed income, pretty much high single-digit returns across fixed income across the board in 2025. What do we do in 26?
Pray?
Pray.
No, look, valuations are high. Spreads are tight. Multiples are high. Commodities are high. Geopolitical risk tensions are high. Uncertainty is high. I think that people are not pricing in enough liquidity or premium to tail risk. That being said, the economy of the U.S., at least, and in the world has done a lot better than people expected, especially after being liberated. So therefore, it's sort of an interesting act between two very different outcomes that could occur. You've seen that, by the way, in portfolio managers, right? You've had some equity portfolio managers that have had outstanding years and some that have had just mediocre years where they've actually underperformed fixed income. And I think that just sort of goes to show the joke about the recession, the economy being a K economy. I think our financial professionals are a bit of a K.
Yeah, that's a good way to describe it. But I think if I had one word for 2025, it might be resilience, right? I mean, from the consumer to corporations, because you see it in their earnings, whatever you threw at us, right? I mean, we just kept coming back. You talk about Liberation Day, even despite the tariffs. I mean, this is an economy that continues to grow at a pretty good clip. We'll see what happens in Q1. But what about opportunities outside the U.S.?
So we're primarily credit-oriented fixed income. And what's great is we've actually found a lot of opportunities outside the U.S., which is one of the few times in my, I hate to say it, 40-year career now. But one of the things that happened was for my first time in my entire career, we invested in a debtor-in-possession syndicated financing bond by Deutsche Bank. So this is something anyone can buy that's a professional. Debtor-in-possession is the debt they lend to companies when they're in bankruptcy. It was an auto parts company, auto OEM manufacturer called Marelli, but you're getting SOFR plus 800. It's coming out sometime in 26, a 102 takeout price, cash required. And what's interesting is, as Japan's interest rates are going up, we're going to see more of this because the government of Japan has been encouraging companies to no longer hoard cash and to be more focused on improving outcomes for shareholders. And there's been activism. So this was an LBO, again, auto parts. It's my first dip. And in Japan, the reason it happened is Japanese institutions view bankruptcy as failure.
Yep.
So they're not willing to participate to create this, and this is what creates the opportunity. And then, so that's a great opportunity. We think the Nordic high yield market still represents the most interesting high yield market in the world today. So we think those two things are very interesting. And then obviously with the commodity plays, that's changing the whole dynamics of how people think about places like Latin America and Africa.
Where do you see fixed income opportunities in your part of the curve? You did a debtor in possession financing, and that's high risk.
Actually, it's very low risk.
Low risk to you, okay.
I think it's actually very low risk. So for instance, when Pacific Gas and Electric went into bankruptcy, they issued debtor in possession financing. It was actually rated BBB. So it was rated investment grade. And the reason I think it's less risk is, yes, a company's in bankruptcy, but you're the first person to get paid, including the tax authorities, and you're usually secured. So unless a company is administratively insolvent or is illiquid and just vaporizes like First Brands, you're perfectly fine. Now, obviously, in First Brands' case, there the debtor in possession financing looks like fool's money.
Yep. So why are you getting paid 800 basis points of spread then if you're safe money?
It's interesting. One, it's automotive, so it's OEM. Two, it's Japan's first dip. Three, they had to syndicate a Japanese company into the Europe and U.S. market. Three, dips pay a big spread because it's a lot of work and very few people can participate, similar to other assets.
Yep.
So if Japan views bankruptcy as failure, what does the U.S. view bankruptcy? Just curious, in your mind.
It's a good question. I don't know. In fact, I don't think the bankruptcy process is working very well in the United States. So back in the 70s, there was no restructuring process. Then they created the bankruptcy laws. And now with all the securitized products like CLOs, asset backs, you have different groups with very, very different agendas, which is why we have the creditor on creditor warfare. I think it's very difficult. And, bankruptcy shouldn't cost $20, $30 million as a starting point to get out of bankruptcy.
2026, where do you guys, from a credit perspective, see opportunities going forward? I
guess it's, again, a K theme. We're going to be on really high quality, relatively liquid stuff on part of the portfolio. And then we hope to be opportunistic on the bottom half. And where we see the opportunistic part is really outside of the United States. There'll be opportunities in the United States, but between the structural issues with, again, the creditors on creditor and the CLOs, unless you're in the club or in the room where it happens from a line from Hamilton, it's a big problem. So where we find the more interesting opportunities is overseas. And we think the Nordic market, which is, I've talked about on the show before, has more yield, better quality securities, but they also went through a big boom. When you go through a big boom, bad underwriting happens. And there'll be underwriting problems. And we think that fundamentally those companies are good companies with bad balance sheets, which is not necessarily the case in the United States anymore. A lot of the U.S. companies that are bankrupt are just kicking the can down the road. And we think that that'll be a very good opportunity. We're involved in one now. We're super excited.
Oh, good for you. Nice way to head into the new year. But real quick before we let you go, the Fed, what your expectations for rate cuts next year?
So I am a bottom-up practitioner with value bent. So people should discount a lot. But it's pretty clear to me that the administration wants rates lower. They're going to get short-term rates lower, whether people like it or not. The real question will be, we have a housing problem, meaning people don't find it affordable. And the question is, what can the government do about making that more affordable? And one of the outliers I have is that somehow the Treasury and the Fed coordinate in buying mortgages or create policy to protect the rates.
David, thanks so much for joining us. Appreciate it. David Sherman, he's the Chief Investment Officer, CrossingBridge Advisors. Talk to us a little bit about the credit side and where there might be some opportunities in 2026. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
We know that consumers have been in it to win it, powering the strongest U.S. economic growth in 2 years in the third quarter when GDP grew at an annual rate of 4.3%. Can it continue? What's the fourth quarter going to show? What's next year going to show? Bill Adams, Chief Economist of Comerica Bank, joins us to give us some insights. So, Bill, a bit of a hard act to follow after that, the number we got for Q3. But what's your expectation for what Q4 might look like? But more importantly, looking ahead, what about Q1?
Q4, I think you have to remember, was the quarter of the government shutdown. And so that was a substantial headwind, and we're likely to see a much softer number for Q4 GDP. I have annualized real GDP in Q4 of under 1%. With that said, I think 2026 is likely to be a year of solid economic growth and broadening economic growth, where lower interest rates from the Fed, and we're expecting rate cuts to likely continue in the new year, are going to support some recovery of existing home sales and industries related to the housing market as well.
Bill, talk to us about, this Federal Reserve's looking at inflation, looking at the labor market. Let's start with the labor market here. What's your view of the U.S. labor market? I mean, if you just look at the headline inflation rate, we're okay. Everything's okay. Don't worry.
There's been a big disconnect in the past year between pretty good real GDP growth on the one hand and a softening labor market on the other. I have been following very closely measures of the labor market that tend to be more cyclical during economic slowdowns. If you look at the unemployment rate for Black or African American workers, that's up to 8.4% in the November jobs report. It's up more than 2.25 percentage points since the middle of this year. That's a very large increase. And so that points to a substantial softening of labor demand in the last 3 to 6 months. We have seen the payrolls numbers holding up, being positive for most of this year. We'll see whether those get revised in early 2026. There is a lot of guesswork. I guess you could say the BLS has an estimate of jobs added at newly forming companies and jobs lost at companies that are going out of business. And that model creates a lot of uncertainty in the payrolls numbers month to month. My sense is that that's likely to be revised down given that the unemployment rate has been moving higher and that we've been seeing these measures like the black unemployment rate softening even more. So I think the Fed, they have a mandate for maximum employment. They don't have a mandate for maximum GDP growth. It's maximum employment and stable prices. And the unemployment rate ticking higher, as well as these forward-looking measures of labor demand also softening, I think points to a need for more support for the economy into the new year.
Well, Bill, you certainly don't have to search far to find wild cards, possible wild cards in next year, everything from AI to we've got the transition happening at the Federal Reserve. But I'm going to throw this out there and say I think the biggest wild card next year might just be the consumer. And a lot of that, of course, is contingent upon what happens in the job market. What's the biggest wild card to your mind?
I think the end of Chair Powell's term in May is going to be a potential source of volatility for the economy and for financial markets. We'll have to see who the new appointee at the Fed is going to be, but I think the president has been open-throated in calling for someone who will support the economy with lower interest rates. And I think that has financial markets nervous about politicization of U.S. monetary policy. Now, I will say over the last couple of months, the case, to my mind, for lower interest rates has become a little more plausible based on economic data. We already talked about the softening of the labor data. If you look at the inflation data, now I don't know how much credence to put into the November CPI report, given the data gaps that we've had recently, but oil prices are down. The housing market continues to soften. That's going to reduce shelter price inflation. Rents are also rising slower nationally, with the largest decrease in rent inflation in the parts of the economy, the parts of the nation where we've added the most housing supply recently, the Sun Belt. So that is going to keep inflation moving on a lower trajectory into 2026. With the exception of tariff price increases, I think the U.S. is set up for a cooler labor market, cooler inflation backdrop in services, which to my mind supports lower interest rates. Might make this Fed leadership transition less fraught over time, but I think as that announcement of the next Fed chair is being made, and as markets are trying to anticipate what that change in leadership could mean, I see that as a potential source of volatility.
Bill, we all know about the K-shaped economy out there. And with that, just kind of as a backdrop, how do you view the U.S. consumer here? Because, boy, it feels like you can never count out the U.S. consumer.
I will say I was concerned about the consumer going into the holidays shopping season. The initial data that we've seen for Black Friday spending going into early December looks pretty good. I think the consumer has again held up the economy this holiday season, probably helped that the government shutdown ended and then there was a reasonable gap between the end of the government shutdown and people getting their salaries again, and then the holiday shopping season really kicking off in late November. I think the consumer, we still continue to have this, as you say, K-shaped economy. Low and moderate income consumers are definitely under pressure from the cost of living, but I think the overall consumer is supported by the asset price increases, especially the robust increase in the stock market in the last year. And a lot of American consumers, an increasing number of American consumers, are retirees. And so for retiree households, it's the cost of living and then also asset price returns and their income from pensions and from Social Security that are driving consumer spending. And retiree households have been under pressure from inflation, yes, but also benefiting from the stock market and from other asset price returns. So I think that part of the consumer market is really holding up the economy and is insulated from concerns about the job market and job availability in 2026, which you see weighing on a lot of conventional measures of consumer confidence, like the Conference Board's Consumer Confidence Index.
Bill, I see in your bio that you're fluent in Mandarin Chinese. What is that about? Where do you pick that up, dude?
I bombed the Spanish placement test on my first week of college, and I needed to pass a foreign language. So long story short, I found myself learning Chinese, and I actually kicked off my career as an economist as the Conference Board's China economist from 2009 to 2011.
All right. There's
See, when you read people's bios, you learn things.
I love that kind of stuff. My son, 21-year-old son, he's all into Japanese, and I'm like, dude, just take French or Spanish like regular people. He's doing Japanese, and he's doing a semester in Japan, and he's got lined up a summer internship in Tokyo. So I don't know. We'll see how that goes. So whenever I see people like Bill, fluent in Chinese, who does that? All right, Bill, thanks so much for joining us. Appreciate it. Bill Adams, he's a chief economist at Comerica Bank. We appreciate getting a few minutes of his time. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Holiday shopping, I think it was, I don't know, it seemed pretty busy out there to me out there in the marketplace. I know people were clicking away on the e-commerce sites.
I know I was clicking away.
Yep.
So a lot of that might have been happening behind closed doors, as they say.
And as you do the returns, some companies are charging you for returns the, what is it, restocking fee, I guess?
That's back. It's a thing again.
Yep. All right. I don't know. There are a lot of gifts under the tree. That's all I know. And I was like, I don't want anything. Julia Wilson, Principal Advisory Strategies, KPMG, based in Atlanta, Georgia. Julia, from your perspective, what are your clients telling you about kind of the holiday season, the retail space out there? Are people spending money?
I think they were, but I think overall your kind of view of a meh holiday might have been the word of the day. So holiday was stronger than expected. We saw consumer spend, the results coming out higher than analysts had predicted. But I would say it was kind of at least in my house, what we called it was the year of the sweater. So it was a very practical holiday spending, withheld all of the headwinds, but it didn't give anybody a ton of surprises. Things were very practical. The smart consumer kind of played out.
Ours was socks this year.
Socks, yeah. I was going to say
how bad is that?
Or you know what? SNL had a great skit. They always do it. It's an old skit, but they did it where the mom gets a robe every year, but everybody else in the family gets like really cool gifts, and she's like, "Okay, I have another robe." So I feel you on the sweater, robe, sock thing. But what about gift cards? Remember when they were sort of all the rage? People were going out and buying gift cards because they didn't know what else to do. Do you think that was a thing this year?
Because it crept up on them. Yeah, absolutely. So I think gift cards, and we'll really see where the consumer plays out in terms of the categories because of the gift card trend. I think a lot of people, the sentiment, and actually we had fewer days between Black Friday and Christmas Day this year. So a lot of people, it caught them by surprise. And so gift card as the gift of choice is definitely something that we predicted with our consumer pulse survey and then actually played out. So I think you'll see a lot of spend over this weekend to see if electronics kind of nudge ahead or if people are still using the gift card to get the things that they kind of were holding out on just as they were, a bit spendthrift over the period.
Alexis, you know that Julia is a big-time consultant because right behind her is a whiteboard. And whenever a whiteboard is brought out in a meeting I'm in, I get up and I leave. Thank you very much. I'm a transaction.
Yeah, it's actually a painting, but I can get the whiteboard's on the other side of the room. There is a whiteboard and lots of business books as well.
That's how they do it. That's how the consultants think. They're big time out of the box. Julia, how do retailers reach their consumers these days? I mean, how do you reach a John Tucker who's not at the beck and call of influencers on social media?
So, the new retail strategy is definitely being where the consumer is. So omni-channel demand is kind of the thing, and finding them whether you do like to see it in your feed. So the traditional social media outlets of Facebook, Instagram, et cetera, are not gone. ChatGPT, Gemini, everything, making sure that you're searchable there and that it's easy to click through is kind of the second area. I would say this is the first year that we really saw AI take off from a consumer perspective. And then the traditional ad, it's not gone. There's some of us that are still in, we watch TV, we watch it, we do things on YouTube, et cetera. And so finding that perfect mix is complex, but we have a lot more tools today to get in front of the consumer.
All right, who here is doing dry January? Dry January being that you don't drink for the month of January.
Oh, please.
John's like,
or
out
a
of your
light.
mind?
I've heard, sprinkle January is another thing. Our consumer survey said about 1 in 3 Americans are participating in dry January. It's for health reasons is the number one reason, but the second reason is to spend less money. So I think if we aren't knocked over the head with the thing of the frugal consumer, we're continuing to see that even as we head into dry January. But it is a restrained consumer thinking about health and wellness for sure.
AI has kind of seeped into all aspects of our lives, all aspects of the economy. How are consumers using AI in their purchasing?
I have to tell you, as a last minute shopper, AI does not bring the package to your door. So that's one thing that we could maybe look for in the future. If you're buying in the last 10 hours of the holiday shopping spree, then you do need to go in a store and physically pick it up. But I think AI is helpful. We just mentioned that the returns that are about to happen. So figuring out where to go, how to print a label, some of those really tactical things that you'd have to sift through and try to figure out. AI is helping the consumer on that side. But from the retailer's perspective, we can't forget just how important it is for them to use it to drive productivity and enhance personalization. So at KPMG, we talk about the front, middle, and back office. AI is really helping us do some of those things of, the chats to when a consumer has a question about how to put together a toy or where to return. Chatbots are one of the first places to leverage AI.
Julia, thank you so much for joining us. Really appreciate it. Julia Wilson, she's a principal at the Advisory Strategy Group at KPMG, talking about retail and retail sales here. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Scott Sperling joins us here, Chief Executive Officer, THL Partners. For those of us that have been in the business a couple of eons, that would be Thomas H. Lee Partners. Did a lot of biz with them back in the day. Scott,
news away.
Thanks so much for joining us here. Talk to us about kind of the M&A environment out there, Scott. What do you expect for 2026? It seems like we've got a pretty decent, we got the Fed cutting rates, the economy's pretty good, earnings are pretty good. It would seem like you guys would be writing some tickets here. What's your expectation?
And certainly on the larger end, if you look at the return to normalcy in terms of our antitrust regime, that certainly opened up a number of opportunities to do things that make sense in terms of bringing companies together that could streamline their costs, provide better service more cost effectively for consumers. So I think those opportunities exist. I think on the private equity side, the cost of capital hasn't been a huge problem. That's not really what's driven some of the slowdown that we've seen over the course of the last 24 months. I think that's more specific to the fact that in the 21 into early 22 period, a lot of things were acquired at multiples that may have made less sense than it seemed to people at the time. And it's taking a while for those companies to grow into their valuations. And that has really slowed down both the number of things that have come to market as well as the ability to get deals done at prices that in today's world would make sense from a risk-adjusted return perspective. So the industry has been slow for the last couple of years in private equity. We do anticipate that picking up. I think time has been helpful there. Companies have continued to perform. by and large, and therefore growing into valuations that might have been too high from a multiple perspective a few years ago. So I think we'll see more activity, hope to see more activity as we go into 2026 in private equity. And as I said, for overall M&A, you are seeing this handful of rather large deals occur that you would not have seen 3 years ago.
Yeah, Scott, because when I was looking at some of the numbers, roughly $4.8 trillion in deal value this year, but the amount of deals were pretty modest, right? So what does that tell you about the deals that are happening and how that's setting us up for 2026?
Sure. Again, we're seeing some very large strategic consolidations. Those are things that under the prior antitrust authorities would not even be considered. Those both the DOJ and the FTC leadership had theories that did not correspond to either the law as most people saw it or to a long tradition about how to evaluate antitrust. And so that put a real chill, as we know, on any kind of activity of this kind. But the opportunity now to actually do things that make sense for consumers in particular, or customers if it's a business-to-business type situation, I think that's allowing these very large acquisitions to occur. That's making up the bulk of that number that you spoke of.
Scott, I'd love to get your thoughts on kind of where the market is in terms of monetizing or exiting investments. It's my understanding that 3 to 5 years is a nice holding period for the average private equity fund, but many funds over the last decade or so have been 5 years, 7 years, maybe even longer, which impacts the returns for your LPs. What's the environment like now for monetizing some of the investments you guys as an industry have made?
So, again, I think that it's getting better. I think that the ability to see more offerings of companies from private equity players so that there, could be more opportunity to see acquisitions occur at multiples that would make sense, that also provide a reasonable return for those companies that were acquired, again, in this particularly, let's call it the 21 to 22 period. It's been more difficult, as I mentioned earlier, for those deals to happen. And as a result, the time frame, the average hold has extended to, I think for many funds that were formed in that period and slightly before, to over that 5-year number. I think 5.8 years is the last number that I saw as average. So that would be longer than we have generally seen for most sets of vintages over the course of the almost 45 years I've been doing this.
Hey, Scott, we've got some big companies on deck to go public next year, including SpaceX and OpenAI. I'm just wondering, what sort of excites you? And if you can't talk specifics there, then what about industries? But I have to think consolidation is going to continue in things like AI and healthcare.
Hard for me to talk about the valuations of entities like that. Obviously, they're building potentially great companies. Whether or not the valuations that they come to market at will make sense over the long term, who knows? I think there's a lot of talk, and we'll see what the reality is. Certainly the market tends to gather momentum when you have IPOs that do well. We've been in a period the last couple of years where even if there's been a good initial pop, the companies that have gone public have tended to float back down towards their original offering, and many of them below. So I think it's really crucial that when companies like that come out, that they come out at valuations that are sustainable and that can provide a reasonable return. I think in terms of areas of growth, we look at areas like pharma services, where there's an enormous confluence going on right now between technology, generative AI technologies that are enablers of drug development and the ability to take those drugs through their clinical trial processes, and the need and ability to provide therapeutics for a whole range of diseases. So we think that's a really interesting area as we look at it. Obviously, the application of AI across a broad range of automation is going to really drive continued productivity, we hope, in the economy that will offset some other flaws that we have when you look below the surface in our current economy. And so companies that are continuing to actually solve more automation-specific problems for a broad range of functions is something that we continue to look at. And then other areas, wealth management, continue to be areas of great interest to us. So we think there'll be a range of things that are going to be interesting opportunities.
Yep.
You have to work really hard in private equity, I would say, these days.
Yep.
Even at the prices that are currently allowing deals to occur, to be able to add value operationally to these companies.
Yep.
You need to have a very specific thesis about how you're going to take a company.
All right, Scott. We're going to have to leave it there, Scott, just because of time. But thank you so much for joining us. We really appreciate getting a few minutes of your time. Scott Sperling, Chief Executive Officer, THL Partners. This is Bloomberg.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.